If you own stocks or bonds, which frankly is most of us, I urge you to watch this video because what Japan is going through can really be called an emergency. In fact, on a CNBC article, one pundit said that what Japan is going through could trigger a global financial market Armageddon. And another one says that Japan looks like it's a ticking time bomb. So this is not clickbait. If you own stocks or bonds, you need to know what's going on. Okay, let's get to the CNBC article, and it's titled Japan's Bond Market Ignites Fears of Outflows from U.S. Carry Trade Unwind and Market Turmoil. Now, we're not going to talk about the carry trade. You can look that up on your own. What I'm going to talk about is what it means to everyday investors, and then more importantly, what we all need to be doing in order to protect ourselves from that. So let's start with the article. And what's going on here, the first piece I want to share with you is Japan's 40-year government bonds have hit an all-time high of almost 3.7%, 3.689% as of Thursday, and they were trading at 3.318%, almost 70 basis points, almost 0.75% higher so far this year. And their yields on their 30-year government debt are up more than 60 basis points to almost 3% to 2.914%, all not too far from all-time highs as well. Okay, so why does this matter? We're going to get to that in a second, but just high level, the tightening global liquidity could reduce worldwide growth by 1%, which is a lot, and rising long-term rates, it could tighten financial conditions and extend the bear market in many assets. Now, we're not seeing that here in the U.S. I should attribute that quote to David Roche, who's a strategist of quantum strategy. We're not seeing that in the U.S., but other parts of the world are, and we're going to get to, could this come to the U.S.? Okay, here's that quote. Japan looks like a ticking time bomb. If confidence in one of the financial market's traditionally safe assets has cratered. So if an asset that is done well cratered, and when bond interest rates go up, what that means is the prices have gone down. Conditions in the global market could go down with it, said Michael Gade, author of Lead Lag Report. A couple more quotes, and then we're going to get into what it means for all of us. Should the Japanese government bond yields continue to climb, the move could trigger a global financial market Armageddon. We're going to talk about why that is, but you can see who that quote is from, Albert Edwards. Okay, so what do we do for that? As I said, if you own stocks and you own bonds, it's important to watch this video, and it's important to watch it for what I'm about to talk about next. And the first thing that we have to do is realize that we are not, most of us, are not professional traders. We don't have to trade in and out of stocks. We don't have to trade in and out of bonds. But we do have to think about what the fundamentals are for good financial planning, what the fundamentals are for good investing. For the fundamentals of good financial planning, really financial planning should be called cash flow planning. And it's really about how do we create a plan to help us meet our goals before we retire. And then once we're in retirement, how do we create a plan so that we know the amount of money that we're spending each year is not going to deplete the assets, and we're not going to have to worry about running out of money in retirement. To do that, you need a good financial plan. I think the gold standard for a great financial plan is to work with a fiduciary financial advisor, somebody that puts your interest ahead of their own. So that's the gold standard, is to work with a financial advisor. But I know many people in my audience aren't going to do that. Working with a financial advisor is not inexpensive. Typically, we charge about 1% a year. I'm now retired, but I was a financial advisor for over 20 years. If you're going to do it yourself, which I know a lot of people in my audience is, I urge you to not use Excel, to not use Google Sheets. It's going to take you a lot more time to do it that way. You could end up with a formula mistake. You could end up forgetting something that's really important. I urge you to use software designed for you, and the software I like used to be called New Retirement. It's now called Bolden. You can sign up for it here. It's very affordable. It's $120 a year, $10 a month. This video is not sponsored by Bolden, but I am an affiliate, so if you click through that link, you will be supporting the channel. Okay, let's keep going. So job number 1 is to have a financial plan. Job number 2 is to have a good investment plan. And for most of us, what a good investment plan means is having a long-term strategy. What percent of our portfolio is in stocks? What percent's in bonds? And a lot of folks think that bonds are low risk, and bonds can be low risk, but they can also be high risk. You heard me talk about Japan's 40-year bonds. What do you think would happen if interest rates on Japanese 40-year government bonds increased by 1 percentage point a year? What do you think would happen to the value of the bonds that were 1% lower? Well, that sounds like a complicated question, but just high level. If somebody said they were going to pay you 1% less a year for 40 years than what you could get today because they bought their tool, they bought their bond yesterday or last year, 1% a year over 40 years, that's 40% difference. Now you got to take the time value of money and things like that, but that bonds could drop 25% or more. It's called duration risk. Duration is just a fancy word for time because it's a long duration bond. So that has interest risk. If interest rates go up, people aren't going to want your low-paying bonds. And what that means is the value of the asset that you own could go down. Same thing with credit risk. If you buy a bond from a company that's not doing well, people are going to say, well, it's great that it's giving me this interest rate, but am I really going to get that interest rate payment in years 5, 6, 7 if that company's going through difficult time? That's called credit risk. So what's important is to have a portfolio that meets your long-term goals, that allows you to hit your long-term strategy. And for many of us, and none of this is financial advice, but for many of us, you look at taking the risk on the stock side. That's where you have exposure to equities, which are going to go up and down because they're not zero risk investments. And so for many of us, taking the risk on the equity side, on the stock side, and then using your bonds to reduce risk, to take less risk. And that's why I say high quality, short duration bonds for many of us is going to be the right match. The other thing I want you to think about is oftentimes when I talk to people, they'll say, hey, Azul, my portfolio is 70% stocks, 30% bonds, whatever it is. But I want to encourage you, instead of thinking of your portfolio as 30% bonds, I want you to think, how many years worth of living expenses do you have in those stable, secure bonds where you don't have to take a lot of risk? Because that'll give you peace of mind if the stock market goes down 20, 30, 40%. If you know you have bonds that hopefully have not gone down in value, that'll give you peace of mind and keep you, when the stock market's down, you're still not going to like it, but hopefully it'll keep you from not liking it to allowing that emotion to go up to what I call angst. And angst is when you just can't sleep at night. So if you found this video valuable, helpful, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.